Are your Singaporean portfolios unknowingly exposed to a brewing economic storm in our own backyard? While global headlines focus on US-China rivalry, the real battleground for your hard-earned capital is shifting to Southeast Asia. A flood of cheap Chinese goods now threatens to drown local industries and derail regional growth, demanding a deep, proactive reevaluation of your investment strategy. Are your Singaporean portfolios unknowingly exposed to a brewing economic storm in our own backyard? All right, folks, Iggy here, your Investing Iguana. Gather round, because today we're diving deep into a fascinating yet deeply unsettling economic phenomenon playing out right on Singapore's doorstep. Forget the complex jargon for a moment. Let's start with a simple analogy. Imagine your neighbor, Mr. China, is a master widget maker. For decades, he sold nearly all his widgets to one rich customer, Mr. America. One day, they have a colossal argument, and Mr. America, frustrated, imposes tariffs, effectively slamming the door shut on imports. Now, Mr. China has a garage full of unsold widgets. He needs to keep his factories running, so he looks around the neighborhood: Vietnam, Thailand, Malaysia, Indonesia. He sets up a table and starts selling his widgets for rock-bottom prices, often below his production cost. This sounds like a great deal for the neighborhood, right? Cheap widgets for everyone. But what if you, Vietnam, are also a widget maker? What if your family business suddenly has to compete with Mr. China's super efficient, often state-subsidized mega factory selling at a loss? This isn't just a hypothetical scenario. It's the exact drama, with billions of dollars on the line, unfolding across Southeast Asia right now. If you're a Singaporean investor with any exposure to regional markets, understanding this dynamic isn't just recommended. It's absolutely critical for safeguarding your wealth. The US-China trade war, initiated in 2018, was a seismic shift in global supply chains. By imposing tariffs on hundreds of billions of dollars worth of Chinese goods, the US made it prohibitively expensive for American companies to import directly from China. This left China's factories, built to serve the American consumer, with a massive surplus. To adapt, they needed new markets fast. So why Southeast Asia? Our region offers a potent combination of factors: strong economic growth and a large consumer market, existing trade agreements and lower tariffs with China, an integrated manufacturing base, and improved logistical links through initiatives like the Belt and Road. However, the nature of this flood is what's concerning. It's not just about increased trade, it's about what many call dumping, exporting goods at a price lower than the domestic cost of production. This isn't fair competition. It's a strategic move to offload surplus and gain market share, often crippling foreign competitors. Key ASEAN nations like Vietnam, Malaysia, and Indonesia have seen their trade deficits with China surge, clearly indicating that China's exports are significantly outpacing its imports, putting local industries under immense pressure. Concrete examples of this deluge as of mid-2024 include steel. Domestic steel industries in Malaysia, Vietnam, and Indonesia have lodged complaints against the influx of cheap Chinese steel, which significantly undercuts local producers due to overcapacity. Solar panels. China dominates global solar production. Facing overcapacity, the region is now seeing a surge in cheap Chinese solar technology, impacting nascent local manufacturers. Electric vehicles and batteries. Chinese EV manufacturers, with state support, are aggressively expanding into ASEAN, creating fierce price competition for local players. Textiles and electronics. Traditional Chinese export strengths continue to find eager, price-sensitive markets in Southeast Asia, making it extremely difficult for local SMEs to compete on cost or scale. The impact on local businesses is not just hypothetical. It's a tangible threat that risks deindustrializing parts of the region and undermining long-term economic development. Imagine a local family-owned factory on razor-thin margins trying to compete with a Chinese state-funded mega-corporation that can export at or below cost. This isn't a fair fight. When local businesses fail, the consequences ripple through the entire economy. Widespread job losses, erosion of economic sovereignty as countries become dependent on imports, and stagnation of local industries that lose the incentive to innovate. This creates a negative feedback loop, impacting the purchasing power of the middle class and dampening domestic consumption. While Singapore's economy is less reliant on heavy manufacturing, this great flood is a critical factor for any Singaporean investor with regional exposure, whether through direct stocks, ETFs, or indirectly via banks and REITs with regional assets. This isn't a distant macroeconomic trend. It's a direct threat to capital in specific sectors and geographies. For now, there are some winners. Southeast Asian consumers benefit from cheaper goods in the short term, boosting purchasing power. Singapore and regional logistics hubs might see increased activity in transshipment and distribution. Sectors less exposed to physical goods competition, such as digital platforms, fintech, and advanced IT services, might be relatively insulated. However, there are also clear losers. Companies involved in basic steel production, solar panel manufacturing, textiles, and automotive components in Vietnam, Thailand, and Indonesia face immense pressure. Investors should reevaluate holdings in companies with significant manufacturing exposure in these vulnerable sectors. Banks with high exposure to SME lending in these sectors could see rising non-performing loans. Regional REITs with industrial and logistics exposure need to be scrutinized for tenant resilience. The biggest, most unpredictable danger for investors is a political backlash. When local industries scream loud enough, governments listen. Countries could impose anti-dumping duties or safeguard measures, creating new trade frictions within Asia. This could disrupt supply chains, complicate regional alliances, and turn investor sentiment sharply negative across the entire ASEAN region, leading to broader market corrections. So what should Singaporean investors do? This isn't a time for panic, but for calculated repositioning. First, reevaluate your Southeast Asian exposure by sector. Are your regional investments heavily skewed towards vulnerable manufacturing? Consider reducing or selling positions in highly commoditized manufacturing companies. Be wary of the decoupling narrative, where Chinese companies set up assembly plants in ASEAN to bypass US tariffs, as the value add for the host country is often minimal. Focus on resilience and differentiation. Look for companies with strong competitive advantages, brand recognition, proprietary technology, or essential services that are difficult for cheap imports to displace. Consider increasing exposure to Singapore-centric businesses, especially in sectors resilient to external trade shocks like healthcare, utilities, or high-end tourism. High-quality, tech-enabled logistics providers and digital infrastructure companies that facilitate e-commerce could be long-term beneficiaries. For those investing via CPF or SRS, direct stock picking and riskier regional manufacturing plays might be too volatile. If you use regional ETFs or funds, scrutinize their underlying holdings and consider rebalancing towards more globally diversified funds or less exposed sectors. For a more conservative approach, stick to Singapore's stable blue-chip companies. Attractive dividend yields in Southeast Asian markets add a layer of risk. Ensure the underlying business is truly sustainable. So, is China using its neighbors as an economic escape hatch? It absolutely is, and the effects are far more complex and perilous than a simple cheap goods for everyone narrative suggests. For Singaporean investors, this isn't just a business story. It's a critical neighborhood drama with billions of dollars on the line. As Iggy the Investing Iguana, I'm keeping my eyes peeled not just on Beijing and Washington, but crucially on the local headlines and policy shifts in Hanoi, Bangkok, Kuala Lumpur, and Jakarta. The real story, the one that will determine the fate of your Southeast Asian investments, is happening there. This great flood of Chinese goods could be the beginning of a whole new economic conflict in Asia, one fought with domestic policy shifts, anti-dumping measures, and intense market competition right on our doorstep. Proactive research, strategic diversification, and a deep understanding of these nuanced regional dynamics will be your best defense and your greatest opportunity. Don't be caught off guard. Adjust your sails now before the storm fully hits. Actionable steps for investors. Review your ASEAN exposure. Identify and reassess exposure to vulnerable manufacturing sectors like steel, basic electronics, and textiles. Rebalancing away from these high-risk areas protects your capital. Focus on resilient businesses. Shift towards companies with strong competitive moats, technological differentiation, or essential services. These are better positioned to withstand price wars and market disruptions. Monitor policy changes. Keep a close watch on announcements from ASEAN governments regarding anti-dumping duties or import restrictions, as these can dramatically alter market dynamics. Diversify your portfolio. If you have significant exposure to commodity-driven economies, consider diversifying into more resilient, services-oriented, or high-tech sectors within the region or globally. Scrutinize financials. For Singaporean banks and regional REITs, dig into the quality and resilience of their regional loan books or tenant mixes to gauge potential non-performing loans or vacancy rates. These practical steps empower you to make proactive, informed decisions rather than reactive ones.